This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Oscar Oberg, thanks very much for coming on Talk Your Book, making your debut on Talk Your Book. I thought it'd be a good place to start if you walked us through Wilson Asset Management, and more importantly, the portfolio that you manage there and what you guys look to invest in.
Yeah, thanks, Chris. Appreciate having me this morning. So Wilson Asset Management was started in just over 20 years ago in 1997 by our founder, Jeff Wilson. So we're a little bit different from some of the guests you've had on the show in the sense that we run listed investment companies or closed-end products that actually trade on the ASX. So we've got 6 listed investment companies that range from WAM Microcap Fund to our small mid-cap product, WAM Capital, large caps in WAM Leaders, and also global with WAM Global. So we run just over 3 billion of funds under management. Myself and a team of 5 look after the small and mid-cap products, which is 4 of those listed investment companies, which is around 1.8 billion of funds under management.
And what company do you want to talk about today?
Yeah, so keen to talk about Adairs, which is certainly a stock that we feel is a good example of how our investment process works, and stock we've owned for some time and very bullish on the outlook going forward.
They had a huge result recently. Why don't you walk us through some of their financial metrics that they announced with their results?
Yeah, so I think it's been a fascinating year for Adairs. Certainly started the year strongly, then acquired the business Mocha in December. And one of the reasons why that attracted us to the business and we bought more shares after that was the fact that it actually increased Adairs' online exposure, and this is before COVID occurred, to around 30% of sales. We've been shareholders for some time in a company called Temple & Webster, which is effectively the only pure play online retailer in the homeware space on the ASX, which had obviously done very, very well. So I guess from our perspective and thinking about our investment process, our view is we could see a re-rating or an increase in the share price just purely off the stronger exposure to online sales. Then, of course, COVID hit. And it was interesting because Adairs actually used debt to fund that mock transaction, and share price, I think, fell from just over $2 to I think around 40 or 50 cents in the lows in March. And I guess everyone was looking at Adairs thinking, geez, they've got a balance sheet problem with sort of $40 or $50 million of net debt. Then, as it turned out, I guess what we've seen through April, May, June, and it's continued on through July and August is just this huge influx and increase of e-commerce sales. And of course, Adairs has been a huge beneficiary of this, given, as I said before, 30% of the sales is focused online. But as people have been staying at home through the lockdown measures, they're spending more on their house. And you've also had a number of the stimulus measures come through as well, and that's benefited Adairs too. So seen a very strong online increase over this time, well over 100%. And certainly the Mocha business that they acquired in December last year has actually done very well. So company beat expectations, and look, we think it's set to beat expectations again over the next year.
And what sort of multiple do they trade on in terms of times free cash flow?
Oh, on a free cash flow basis, that's testing me, Chris. But on a price on a price earnings multiple, on our numbers, we've got it trading on around 12 times earnings.
Yeah.
Now that compares to Nick Scali, which is their key peer in the market, around 17 times earnings. And we think over time, Adairs deserves to trade towards that multiple. Look, Temple & Webster's in its own sort of space in pure play online retail and trading at a very high multiple there. But look, over time, we think Adairs can get to that 17 times.
Reading their results presentation, they speak about the importance of omni-channel. It's a way for traditional retailers to try and, almost carry some favour in the investing community, I reckon. We don't hear Temple & Webster talking about the importance of omni-channel, or no one's complaining that Amazon don't have a lot of brick and mortar shops or Kogan. How much importance do you place on that omni-channel? And if you had your way, would it be a pure online play?
Yeah, I think it's a really good question. I think, we certainly see the landscape for retailers or traditional retailers change over time. So Adairs has just over 160 stores at the moment. Now, years gone by, they would have been saying we're going to increase this to 180 to 200. But I think clearly the landscape has changed. Now, Adairs is what we've seen with Adairs over time is they've tried to transition the portfolio into much larger stores in homeware centres, and that's generated a very good return for them. It actually gives them a 10% uplift in their profit on a per store basis. So we think over time that I think it's 167 stores that they have, we don't think it'll change that much. And given sort of they've got around 40% of their leases in holdover or that expire in the next 12 months, we see a whole heap of change around the portfolio. So we'll see some stores go if they can't meet the appropriate financial return with their landlords, or we'll see some larger stores stay. So look, we think that the store network will stay around where it is, but then obviously all the growth will come, or a big portion of the growth will come from their online channels.
Putting Adairs maybe to one side and more in a helicopter view of the retail landscape, do you think the way tenants engage with landlords around rental agreements are going to have to change to encourage tenants to take the jump and actually sign on for leases? Do you think they go to a percentage of sales or a cost per level of foot traffic that goes into the store or walks past the store? Do you see any long-term changes in the retail landscape there?
Yeah, again, it's so fluid at the moment. I think a number of the retailers would like a percentage of sales, certainly, particularly some of the department stores that are obviously battling through this period. I think the landlords are going to fight to keep it the way it is at the moment. I think there will be reductions, and certainly in those sort of B or C grade centres, in regional, in suburban areas, I think there will definitely be pressure on rents. But I think, in your A grade, in your Chadstones or Bondi Junctions of the world, I think, the landlords will fight as hard as they can to keep rents there. So, look, I think it's so fluid at the moment. It's sort of hard to know where it's going to go. We saw what happened with Mosaic Brands last week, effectively shutting all their stores in Westfield, but they've come to an agreement now. So, yeah, it's interesting. I guess the feeling we get speaking to the landlords over reporting season, they don't want to go to a percentage of sales. So it'll be interesting to see how it plays out, but you would assume that the pendulum has swung in the favour of retailers, given what we've seen through COVID.
In terms of Mocka or their debt profile, I think their net debt's down to $1 million. Is that right?
It's almost, probably net cash now, so no debt effectively.
Which is amazing. So maybe talk us through that Mocka acquisition. They're a New Zealand-based business. Talk us through that, what the potential are to cross-sell either Adairs products over there or Mocka products into Australia, and how you see that playing out.
Yeah, so Adairs bought Mocka sort of December last year, and assuming that they hit all their earnouts over the next couple of years, they should pay about $85 million for it, which is actually on a multiple, in terms of the multiple they paid, it's actually 6.5 to 7 times EBIT, which is actually unusual for an online-only retailer such as Mocka. It's actually been profitable through its existence. So if we look at Mocka, and I'll talk pre-COVID, there was about $30 million of sales in New Zealand and only $30 million of sales in Australia. So clearly the Australian business was very small. What we've seen through this period, Mocka has outperformed. Demand for the products are high. They only had $8 million of inventory at the August result, which shows they've probably been missing sales because they haven't had a lot. But at longer term, where's the upside for Adairs and Mocka? Well, Adairs has one of the most loyal followings in the retail market in Australia. It's Linen Lovers membership platform, which you actually have to pay to be a member. Has over, I think it's 800,000 members, and actually generates over 75% of Adairs' sales. So clearly the opportunity there is to cross-sell to your Linen Lovers members within Adairs and into Mocka. And it does have very complementary items that do fit with the Adairs, footprint of what they sell. So, yeah, we do see synergies over time. I think it's probably too early at this stage. I think, to be fair, I think it's just been mad for the business and management, managing this whole period and just getting the right stock on the floor to actually get sold. So, but I think certainly over time, we do see upside there, and in particular that Australian business, which is very, very small at this point in time.
And they mentioned their results that they had $90 million worth of spare capacity in terms of debt and cash on their balance sheet. Do you see them being a roll-up player, and you think there are other acquisition opportunities they'll be looking at, or do you think it'll be a time for them to consolidate their different business units now?
Look, it will be fascinating. I think it'll be fascinating looking at the whole retail sector, actually. I think there's been a number of companies like Adairs that had balance sheets we were worried about, and just through the enormous amount of demand for retail sales over this period and the fact they're not discounting, balance sheets look fantastic. So there is the potential for M&A over time. I think for the Adairs, the management are very conservative. Mocha was their first real acquisition since they've IPO'd. Look, at this stage, I don't think they'll be looking for acquisitions in the next 12 months. However, I guess this has been a crazy period. It's going to be hard for them to comp these sales. So never say never. And certainly the balance sheet should be well into net cash as we get through Christmas. So I'd say not on this stage for Adairs, but I wouldn't rule it out.
And so in terms of, or in the interest of balance, it's like I said, the results were just incredible. But in terms of what's happened since COVID, we've had huge government handouts. Many people have paused their mortgages. Many people have redrawn on their super. Plus people in many places in Australia haven't been able to spend on non-discretionary items such as, restaurants or going on holidays. There's been a huge excess pool of money to essentially buy goods with. That's going to start unwinding now. And by March, April next year, things will be back to some level of normality you'd expect, or a new normal. What's your thesis on how that's going to play out for a retailer like Adairs, who's enjoyed the tailwinds in this pretty unique period?
It's 100% definitely the risk for the retail industry, not just Adairs, but just JB Hi-Fi, a number of them. I think what gives us faith in Adairs, going back to Mocha, it's a very small business in Australia, so the growth potential there is huge, and the same goes for Adairs Online. So if we look at the business today, I think online sales for Adairs will be well over 40% in the next 12 months, which is upwards from 20% this time last year. So we do think that from an online perspective, and this is why we're quite positive in a number of the e-commerce players for the work we've done, we actually think that they can go close to comping that March to June period. And then we go back to what you said before, we've got a very strong balance sheet. So we could be sitting here in a year's time, even though I don't think it's likely in the near term, but perhaps there's acquisitions on the table as well. So look, we're quite bullish on the opportunity for Mocha and Adairs Online, and we think that those businesses can continue growing. But certainly, you're 100% right. Particularly the fact we can't go overseas on holidays. So that's just huge for Australians, and it's been plowed back into the home. But I guess in terms of how we see numbers for this year in particular, we see big upgrades coming through for Adairs. Which will, as you said before, will improve their balance sheets, give them a heap of opportunities going forward.
Beautiful, mate. We really appreciate you coming on. It's a great story. Thanks for taking the time.
Cheers, Chris. Thanks a lot.
Thanks, Oscar.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.